The shocking link between sports wins and state taxes. Summer is right around the corner, and sports fans across America have a lot to look forward to. Basketball's 13-month-long season is finally starting to heat up. Some might wonder if regular season games even matter. Next, someone will say there's a summer league too. Hockey playoffs are coming to a close. Baseball is in full swing, and professional football players are getting ready to report to training camps. Stop at any bar or water cooler and there'll be talk of wins, losses, and plays that fans just have to see. Fans and analysts have all sorts of statistics they use to measure and debate their team's performance. Turf investors have relied on the daily racing form for over a century. Baseball is famous for legions of sabermetricians who track statistics like wins above replacement, batting average on balls in play, and the largest wad of chewing tobacco. Yes, that last one might not be official. Football, basketball, and even hockey all have measures that go far beyond the final score. But there is one more statistic that many do not expect. It is the surprising impact of the state income tax rate. Eric Hembry, a senior economist for the Federal Reserve Bank of Minneapolis, explored this idea. Back in 2017, when he was an assistant professor of economics at the University of Illinois at Chicago, he released a paper titled Income Taxes and Team Performance, Do They Matter? He might have also lined himself up a future job with a struggling team if the whole economics thing does not work out. Here is what his study found. Hembry started with win-loss records from the last 40 years of the Big Four professional sports leagues. Then he added data on each state's top marginal income tax rates. This approach was a shortcut because not every player earns enough to pay the top rate, but it was close enough for government work. Finally, he ran the tax rates against win percentages to estimate their effect. The exact equation included Greek letters and complex symbols, but no one wants a math lesson today. So here is the bottom line. State income tax rates significantly impact team performance. In the National Basketball Association, where the effect is strongest, moving a team from high-tax Minnesota to tax-free Florida could add 4.7 more wins each year. That is the equivalent of swapping a mediocre bench player for a 2015 version of Draymond Green. In Major League Baseball, where there is no salary cap and the tax effect is smallest, the same move would still add 1.6 wins per year. And this effect is getting stronger as free agents gain more flexibility to move between teams. Why does this happen? Hembry suggests that lower state income taxes make it easier for teams to attract and afford top talent. While state tax rates might range from 0 to 14%, once players have paid agents, managers, and federal taxes, the real burden of state taxes can be more than double the headline number. At first glance, it might seem like the average person has nothing in common with athletes deciding between multi-million-dollar contracts. But when athletes look at tax rates before signing a deal, they are doing tax planning. And smart individuals and business owners can do the very same thing. Tax planning is not just for the rich and famous. It is for anyone who wants to keep more of what they earn. David Tuck, a former IRS auditor and Portland tax consultant, believes that tax planning should be a part of every winning strategy. When you are ready to play ball with your own financial future, David Tuck and his team are here to help you hit a grand slam.